Everyone, welcome to your channel. Whether you are an investor, a student, or someone working in finance, ratios are a key tool in analyzing a company's financial health. They provide us with quick and insightful ways to evaluate how well a business is performing. In this video, we will go over the most common types of ratios and explain what they tell us about a company's performance. Let's dive right in. So, what exactly are financial ratios? Simply put, financial ratios are mathematical comparisons of two or more items from a company's financial statements, like the balance sheet, income statement, or cash flow statement. These ratios make it easier to compare a company's performance over time against its peers or even against industry benchmarks. The real power of ratios lies in how they simplify complex financial data, turning it into something that's easier to interpret and useful for decision making. Financial ratios are divided into five main categories: liquidity ratios, profitability ratios, leverage ratios, efficiency ratios, and market value ratios. Each category helps us understand a different aspect of a company's performance. For instance, liquidity ratios help us see if the company can pay off its short term obligations, while profitability ratios show us how well the company is generating profits. Leverage ratios focus on debt levels, efficiency ratios on asset usage, and market value ratios tell us how the company is valued in the stock market. Let's start with liquidity ratios. These ratios measure a company's ability to meet its short term obligations, meaning how well it can cover its bills that are due within the next year. Imagine you are looking at a company's balance sheet. Liquidity ratios help you determine if the business has enough cash or assets that can be easily converted into cash to pay off its current liabilities. This is crucial for understanding if a company can avoid cash flow problems, especially during tough economic times. A company with good liquidity ratios is considered financially stable in the short term, which is always a positive sign for creditors and investors. Next, we have profitability ratios. These are some of the most important ratios both for investors and managers because they focus on the company's ability to generate profits. They help us understand how much profit the company is making relative to its revenue, assets, or equity. For instance, by looking at these ratios, you can determine if the company is controlling its costs effectively or if it's successfully increasing its profit margins over time. Ultimately, profitability ratios give us insight into how well a company is doing in terms of generating returns and creating value for shareholders. Moving on, we have leverage ratios, which are also known as solvency ratios. These ratios tell us how much debt a company is using to finance its operations. In other words, they show the balance between the debt and equity in the company's capital structure. A company that relies heavily on debt may grow faster, but it also takes on more risk, especially in periods of economic downturn or rising interest rates. Leverage ratios help investors and lenders assess the level of risk associated with the company's debt load. While debt can be a useful tool for growth, too much of it can lead to financial instability. Now, let's talk about efficiency ratios. These ratios focus on how well a company uses its assets and resources to generate revenue. In essence, they measure the company's operational performance. For example, an efficiency ratio might show how quickly the company turns over its inventory into sales or how effectively it uses its assets to produce income. If a company is very efficient, it means it's making the most of its resources and minimizing waste. On the other hand, low efficiency could point to operational bottlenecks or poor management of resources. These ratios are especially important for industries where asset management is the key to profitability, such as manufacturing and retail. Finally, we have market value ratios. These are the ratios that helps investor evaluate how the market perceives a company's value. They provide insight into whether a company's stock is overvalued or undervalued compared to its earnings, dividends, or other financial metrics. For investors, these ratios are useful for deciding whether to buy, sell, or hold a stock. They can also help in understanding how the company's performance compares to the market as a whole. For example, if a company's stock is trading at a high price relative to its earnings, investors might believe that the company has strong future growth prospects. Alternatively, a low market value ratio could signal that the market expects the company to face challenges. In conclusion, financial ratios are powerful tools that provide a quick and comprehensive view of a company's financial health. Liquidity ratios help us assess the company's short term stability. Profitability ratios measure the ability to generate profit, and leverage ratios tell us about the risk associated with debt. Efficiency ratios show how well it uses its asset, and market value ratios help us understand how the company values how the market values the company. Remember, it's always a good idea to compare these ratios against industry averages or competitors to get a more complete picture. By analyzing these ratios together, we can make better decisions, whether as investors, managers, or analysts. Thanks for watching. If you found this video useful, don't forget to like, share, and subscribe for more content on finance education and tips.